Welcome back to our intermediate financial accounting class. Over the last couple of segments, we've been talking about long-term debt. We talked about the general concepts, why it's so important, and then we talked about bonds and the way we record bonds as one of our two examples of long-term debt. Later on, we'll talk a little bit about mortgages and notes payable as our other example. For now, I want to pick up with the example that we started last time, and here it is. Epistone is looking to issue a bond to help them build a new building, and they've got three options, and they've got to decide which one will be best. And we're going to use this as an opportunity to practice the journal entries that go along with bonds. We took a minute right at the end last time to talk about how each of these bonds is going to issue, and I wanted to emphasize the fact that you need to take a few minutes to decide whether it's a par, premium, or discount right up front to avoid making mistakes later on. So we're going to start with the journal entries for bond 1, which is going to issue at par, and see what it looks like when there is no premium or discount that needs to be amortized away. So we want to record specifically the issuance and then the first two interest payments for this bond. And we really don't have to do a time value calculation here because it's par. So in reality, I could just say, well, it's issuing at par, so I'm just going to use 800,000 and be done. But just this once, let's go ahead and do the calculation so you can see how it really does come out to be the par value. So if we're going to do a bond calculation, the first thing we need to know is the face value, and that's 800,000. The next thing we want to know is the stated rate, and that's this 12% right up here, so we'll put this down. And you need to know the interest payments that will be made. So to get that, I take the face value times the interest rate, stated interest rate, and divide by the number of payments per year. And since this is an annual bond, my payments per year will be 1. And that's going to give me 96,000 as my interest payment. Once I know that it's going to be a par value bond, which I do, and I know what my interest payment is, then I don't need this rate anymore, and I don't want to accidentally use it, so I'm going to cross it out. Next, I need to know my N, and my N is going to be the number of years times the payments per year, so it's going to say 10. And I need to know my market, or effective rate, which is the rate that we were given before for all of these bonds. So let's go back and just take a quick look. It's this number, right down here, this 12%. So I'm going to use that in my information, 12%. Again, divided by the number of payments per year, so it's going to stay 12% in this case. Now that I know these numbers, I can do my time value calculation. The present value of the interest will equal the payments times the present value of an annuity factor at N, which is 10, and my market percentage, which is 12%. And I can go to my tables and find this factor. Let me go ahead and switch to my table. So present value of an ordinary annuity, we have 12%, and we're going to go down to the row for N of 10. And it's going to be 5.65022. So 5.65022. And if I multiply the 96,000 by the 5.65022, I get 542,421. Now I need the present value of that face value. That's 800,000 times the present value of a lump sum, N of 10, 12%. Again, we need to go to our time value tables to get that number. So I'm going to switch to my present value of a lump sum. Again, row of 10, 12%, 0.32197. And if I multiply that factor by the 800,000, I get 257,576, and if I add those up, I get 799,997. Well, it should have come out to 800,000. Shoot, you've got a $3 discount here, Jason. You're going to have to do amortization and all this. No, you're not. $3 off. That's actually really pretty good when you're using the tables. In Excel, it rounds out to like 12 or 15 decimal places. A financial calculator goes out to 8 or 10, depending on the brand. They're going to get all the way to the 100,000. These tables only got 5 decimal places, so they're going to be off a bit because of rounding. So I would say if you're within about $10 on a bond less than $1 million, and on a bond between $10 and $20 million, you're probably within 25 bucks, and it just kind of goes up from there. The bigger the bond, the more rounding issues you're going to have. But as long as you're within, I don't know, $50 to $100, it's probably just rounding error, especially with really big bonds. So in this case, I would just say up, rounding error. Sure enough, it comes out to par. We're good. And now that I know my present value, I can do my journal entries. And I need to do 2 of them. I was asked to do the issuance and then the first 2 interest payments. But since it's par, there's only going to be 1 interest payment entry, and I'm just going to make it multiple times. It's not going to ever change. So my journal entry, I'm going to get $800,000 in cash, and I'll record a bonds payable. And we issued an $800,000 12% 10-year annual bond at par. Next, I'll do my interest payments, and my interest payments are all going to look the same because I have nothing to amortize. So my interest expense will be the $96,000, and my cash going out will be $96,000, and this will be interest payment on bond 1. Those are my journal entries, and I'd make that same $96,000 interest payment all through the life of the bond. When I get to the end, I'd credit cash for $800,000, I'd debit bonds payable, and I would be done with this bond. So par value, nice, simple example of what a bond looks like. Let's take a look then at one that's a little bit more challenging, and that's bond number 2. Bond number 2 is a little bit different because it did not issue at 12%, it issued at 10%, and we said that made this a discount bond because the effective rate was 12%, or the market rate. So since this is only paying 10 and the market wants 12, we're going to end up getting a little bit less than we wanted for this bond. We need to start out by calculating the present value of this bond so we know how much cash we're really going to get and how much we're going to get hit by this. So let's set this up again. Our face value is $950,000. Our stated rate is 10%. Our interest payment will be the $950,000 times the 10% divided by the number of payments per year. This is a semi-annual bond, which means I'm going to make 2 payments each year. So I'll divide by 2. So each payment is going to come out to $47,500. Now that I know my interest payment and I know that it's a discount, then I can get rid of this 10%. I don't want to accidentally use it. So let's see. Now I need to know my N, and it's a 12-year bond, 2 payments per year. So my N will be 24. And then I need to know my market rate. And my market rate we said was 12%, but this is semi-annual. So 6% will be my market rate. So now I can do my time value calculations. The present value of the interest will be the $47,500 times the present value of an annuity factor, 24 and 6%. Let's go back to my table and get this value. So N of 24, and we'll scroll across to 6%. So here's the number that we need, 12.55036. So if we multiply the 47.5 by that 12.55036, we get 596,142 as the present value of the interest. The present value of the principal is going to be the 950,000 times the present value factor. We're going to use these same numbers from right up here, 24, 6%. I've had a lot of people ask me over the years, why do you have to use the 24 and the 6%? Why can't you use 12% and 12 as your N? I mean, you're not making actual payments with this face value. It's just going to be paid once. And the reason is because the bond as a whole is compounding over these 24 payments. If you use 24 and 6% for one half of the bond and 12% and 12 for the other half of the bond, then it's like adding up apples to oranges. In order to get the compounding for the whole bond to work, you have to use the same N and the same percentage for both pieces. Let's go to our table and get this value. So N of 24, 6 as our rate, so 0.24698. 0.24698. And if we multiply that out, we end up with 234,631. And we'll add those two up to get our bond value, and that's going to be 830,773. And we're going to stop right there and we're going to say, wait, did we get what we expected to get? And we're going to compare the 950 to the 830. Yep, that's a discount. They're going to pay us less than we wanted because we're not offering a high enough interest rate. Perfect. Maybe not perfect from the company's perspective, we want more money, but perfect from a calculation perspective, we got just what we expected. Now we're ready to do our journal entry. So we're going to get cash if we sell this bond of 830,773. We're going to have a bond payable of 950,000 and a discount for the difference of 119,227. This is issued a $950,000 12-year semi-annual 10% bond at 12%. Now I've done my first journal entry. Now I'm ready to do my first two interest payments. We're going to use the effective interest method, and that means I need T accounts. So here's my bonds payable account. Here's my discount account. We'll put in bonds payable of 950 and my discount of 119,227. And you can see, since this one's got a credit and this one's got a debit, if I wanted to put bonds payable net on my balance sheet, I'd subtract the 119 from the 950 and I'd get what the bond is worth right now. That's what makes that my book value and make sure that the discount reduces the bond value. Let's go ahead now and do our interest expense entries. And there's really 3 steps to those, and we're going to walk through each step one at a time. So this is my first payment. And step number 1 is to get the carrying value or the book value, whatever you prefer. To do that, I take the face value of the note, 950,000. Minus the discount. If it was a premium, I would add it, but with a discount, I subtract. So 119,227. And I know I subtract, like we just mentioned, because this has got a credit balance and that one's got a debit balance, so we can't add them together. And that gives me the 830,773, which for the very first interest payment, that number needs to match up with the cash that we got. Step number 2 is to calculate interest expense. When we've done these in the past, they've been interest revenue. Now it's interest expense. And to do that, I take the book value times the market rate. And we're going to use the 6% because that's the market rate that went into the time value problem. We don't use the rate that was given, that's an annual rate. We use the rate that was actually in the time value problem so that it's already adjusted for semi-annual, quarterly, monthly, whatever it is. Now we'll round this to the nearest dollar, and we're going to get interest expense of 49,846. And we're going to use that up here in our third step, which is the journal entry, the best part. So I'm going to debit interest expense $49,846. I'm going to credit cash, and I know how much cash I'm paying because I calculated it as part of my time value calculation. So here it is. It's this 47,500. So 47,500, and the difference to make that balance is what I amortize away out of my discount. So $2,346 will make that balance, and this is my first interest payment. And I'm going to take this number down here and get a new discount amount of $116,881. Let's take a look at one more of these interest payments so that we can make sure we're comfortable with it. So our second payment, we go through the same steps. So step one is the book value. So $950,000 minus the discount, but the discount's not $119 anymore. We can see down here it's $116,881. So $833,119. I use that number in step two, which is to get the interest expense. So $833,119 times 6% gives me interest expense of $49,987, which leads me to the best part, the journal entry. So interest expense is $49,987. Cash doesn't change, and the difference again becomes my discount, and this time it's $24,87. Second interest payment. And I can take this down here. This would, I guess, be step four, would be getting this new balance. And there we have it. Now, we've done this with effective interest. Let me take just a second and show you what this would look like under straight line. So if we were to use straight line instead, I would take that initial discount amount right down here, and I would divide by n, which in this case is 24, and that would give me, just round to the nearest dollar, 4,968. And what I would do now is I would amortize away that much every time. So I would credit discount by 49.68. The cash, I know that's contractual, so that's not going to be any different. And then, since I know the two credit numbers, I can back into the interest expense number to make that balance, and it's $52,468. And this would be interest payments on bond 2. And the interest payments under straight line would be exactly the same every single time because I'm using straight line. And since it's straight line, I do the same amount of discount every time all the way through. So a little bit easier, I guess, not nearly as much fun as the effective interest calculations. FASB doesn't like this one because they feel it smooths things out a little too much. Since we use the effective rate or the market rate to get that present value in the first place, we should unwind the present value, that's their term, using that same effective interest rate. So again, we can only use straight line if it's not materially different from the effective interest method, and you can see here about $3,000 change in the interest expense. Depending on the size of the company, that might very well be material. So we may end up being stuck with the effective interest method. We're going to end there. What I want you to do is do the journal entries for the issuance and the payments on bond number 3, and I will see you next time with the solution. See you then.